Wednesday, January 28th, 2026. What you're witnessing right now is not just another metals rally. This is capital abandoning paper promises at a velocity that is rewriting every expectation held by institutional players who have spent decades dismissing physical assets. It is a silent global stampede out of financial abstractions and into tangible, hold-in-your-hand reality. The warnings were dismissed as alarmism, the data was ignored as noise, but tonight, the numbers on the screen speak with a finality that cannot be argued with. Silver is trading at $160.62 per ounce as of this evening. Gold has not just broken a barrier, it has vaporized it, pushing through $5.411. And beneath it all, the foundation of the modern financial system shudders. The United States dollar index has collapsed to depths not witnessed since early 2022, before the Federal Reserve deployed the steepest rate increases in 4 decades in a desperate and ultimately failing bid to control the narrative. But the most critical piece of intelligence, the signal flashing bright red in the chaos, is not on the main ticker. It is in the arbitrage windows, in the frantic wire transfers between trading hubs. Here is what the talking heads on financial networks are not discussing openly, what the official reports will downplay until the moment it becomes undeniable. Shanghai buyers are currently paying a premium of $15 per ounce above the London spot price just to secure physical, deliverable silver. 15. That is not a pricing error. That is not a minor market inefficiency. That number, right there, is a fracture in the global monetary supply chain. It is a direct measurement of panic, a quantifiable gap between the paper market's fantasy and the physical market's brutal reality. It reveals something far more dangerous than any chart pattern or analyst projection. The system is breaking. The promise that a paper contract will always be exchangeable for the real metal it represents is now being tested. And in the world's largest consuming region, that promise is failing. The premium is the insurance price against that failure, and tonight, the premium is screaming. For those who have followed the structured accumulation phases of 2024 and 2025, this is not a surprise. It is a validation. You understood then what is becoming obvious to all now. Physical metal ownership does not represent speculation. It is not day trading. It is structural protection. It is the ultimate insurance policy against systemic monetary dysfunction. It is the lifeboat on a ship that has spent years pretending it was unsinkable, while quietly removing the rivets from its own hull to sell for short-term profit. What is unfolding across global exchanges tonight is the culmination of every warning issued about the growing, and now critical, disconnection between the sprawling, leveraged paper markets and the actual dwindling, deliverable inventory in vaults. The derivatives market for silver is a skyscraper built on a foundation the size of a suitcase. For years, everyone agreed to pretend the foundation was larger. Today, someone in Shanghai is trying to take delivery of the suitcase, and they are discovering it is not only full, it is empty. Their willingness to pay an extra $15 is the sound of that realization hitting home. This is not an isolated event in a single commodity. These are synchronized shockwaves. Let us establish the baseline facts with the precision this moment demands. Silver did not just rise, it exploded to an all-time high of 117.60 earlier today, according to Live Comics data. This is not a gentle curve on a chart, it is a vertical line. Gold's journey is similarly historic, smashing through the psychological fortress of $5,200 on its way to its current citadel above $5,400. This is not mere strength, this is a repudiation. And driving this repudiation is the accelerating decline of the benchmark currency. The US dollar index now sits at its weakest position in 48 months, a 4-year low that speaks of a profound loss of faith and a frantic search for alternatives. These movements are not isolated. They are the interlocking gears of a single massive engine of monetary transition. The technical indicators, often dismissed as lagging, now paint a picture of undeniable momentum. The 20-day moving average for gold is rocketing upward. The 50-day sits firmly at $4,150, a level that was itself an unimaginable peak just months ago. The 200-day, the bastion of long-term trend, rests at $4,200. Every single major technical indicator slopes upward in a textbook, almost frighteningly perfect, bullish alignment. Price action is not just rising. It is extending further from every known support level with each passing trading session, like a rocket escaping gravity with increasing ease. But the story of silver compounds this pattern into something truly historic. The metal more than doubled in value throughout the turbulent year of 2025, posting its strongest annual gain since the inflationary chaos of 1979. That alone should have been the story of a generation. But 2026 did not begin with a consolidation or a pullback. It began with a detonation. In just the first 3.5 weeks of this new year, silver surged an additional 50% higher. Let that number resonate, 50% in under a month. This is not normal volatility. This is not healthy price discovery. This is the violent market-shattering collision of three unstoppable forces: a structural physical deficit in the market, a tsunami-like investment surge from capital-seeking refuge, and raw, unadulterated industrial desperation from sectors that cannot function without this critical element. The deficit provides the tinder, the investment surge provides the spark, and the industrial demand provides the oxygen. Together, they have created a firestorm. And at the heart of this firestorm, the single most important indicator, the key that makes everything else comprehensible, is that number from Shanghai, the $15 premium. It is the canary in the coal mine, the tremor before the earthquake, the proof that the physical market has finally declared its independence from the paper fiction. This is where the real story begins. This is where we stop watching the ticker and start watching the trucks, the vaults, and the desperate moves being made in shadowy boardrooms and gleaming trading floors across the world. The repricing of risk is over. The repricing of reality has begun. That $15 Shanghai premium is not a number in a vacuum. It is a symptom, a fever spike, indicating a deep and systemic infection within the global metal supply chain. To understand its gravity, we must follow the trail. We must look past the trading terminals and into the logistical nightmares, the whispered conversations in refineries, and the sudden opaque statements from institutions that never wanted to draw attention. Airlift operations moving refined 1,000-ounce bars across continents are no longer the stuff of thriller novels or wartime logistics. They are Tuesday. Charter jets, once filled with luxury goods or high-value executives, are now packed with pallets of silver, their flight paths tracing urgent multi-million-dollar arcs from private vaults in Switzerland and London to secured facilities in Singapore, Hong Kong, and Shanghai. The cost is astronomical. The urgency is palpable. This is not efficiency. This is triage. When the premium covers the cost of flying an ounce of metal halfway around the world, you know the traditional channels, the slow boats, the insured containers, the bureaucratic customs clearances, have broken down. The supply chain is not stretched, it is snapping. Simultaneously, the world's largest processors and refiners, the quiet industrial giants who melt down, mined concentrate, and turn it into the LBMA-approved good delivery bars that back the entire system, are issuing statements they have never had to make before. Phrases like allocation, extended delivery timelines, and force majeure are creeping into their client communications. These are not companies prone to drama. They are the plumbing of the system. When the plumbers start sending out warnings that the water pressure is dropping, you don't question them. You start filling your bathtub. These unprecedented statements are not sentiment indicators. They are cold, hard supply crisis markers. They confirm that the raw feedstock is not arriving fast enough, that the queues at their doors are growing longer, and that the promise of future delivery is becoming just that, a promise, increasingly detached from a guarantee. This physical scramble is the dark matter exerting its gravitational pull on the paper universe. The COMEX and LBMA spot prices are struggling to keep up, like a lagging echo. The paper market is built on the assumption of infinite liquidity and instant settlement in cash, not metal. But when a critical mass of participants suddenly wants the metal itself, not the cash equivalent, the entire mechanism begins to grind. The leverage that amplified gains on the way up becomes a terrifying multiplier on the way down for those on the wrong side of the trade. The shorts, those who sold silver they did not own betting the price would drop, are now facing a margin call from reality itself. They cannot simply wire cash to settle. They must deliver a bar that increasingly does not exist in the registered vaults at the promised price. Their desperate buying to cover their positions only fuels the vertical ascent, creating a feedback loop of agony. This is the short squeeze of legend, but it is not driven by speculative day traders. It is driven by the fundamental physical deficit of the metal. Now, layer onto this the macroeconomic landscape, the kindling that was waiting for this spark. The US dollar's decline to a 4-year low is not an unrelated event. It is the core catalyst. For decades, the dollar's strength was a self-reinforcing dogma. It made dollar-denominated debt cheap for the world and dollar-priced commodities, like gold and silver, relatively expensive for holders of other currencies. That paradigm has inverted. As faith in the currency erodes, the traditional strong dollar suppresses metals relationship fails. Investors and nations alike are engaging in a frantic wholesale rotation out of dollar-denominated paper assets, treasuries that offer negative real yields, corporate debt of questionable solvency, and equities priced for perfection in an imperfect world. They are not rotating into other currencies, which are seen as different flavors of the same fiat problem. They are rotating into the anti-currency. They are buying monetary energy. Gold is the primary vessel for this energy. Its breach of $5,400 is a historic line in the sand telling every central bank, every sovereign wealth fund, every pension fund manager that the era of trusting unbacked ledger entries is over. Gold is the reset button. But silver? Silver is something else entirely. It is gold's volatile, high beta sibling. It is monetary energy and industrial utility fused into one. This dual identity is what makes the current explosion so potent and so dangerous for the status quo. On one hand, it is absorbing a massive share of the fleeing monetary capital. The poor man's gold narrative is dead. It is now the smart investor's gold. On the other hand, its industrial demand is utterly inelastic. It is not a discretionary metal. It is the irreplaceable conductor in every EV, every solar panel, every piece of 5G infrastructure, every advanced medical device. The green energy transition, touted as the path to the future, is built on a silver foundation. That transition did not pause because the price rose. It accelerated, locking in future demand at any price. The industrial users are not speculators, they are existential buyers. They must secure physical inventory to keep their production lines running, contracts fulfilled, and companies solvent. They will pay the premium. They are paying the premium. So we have a perfect, self-reinforcing vortex. 1, a falling dollar pushes capital into hard assets. 2, gold leads the charge, breaking psychological barriers and pulling the entire precious metals complex upward. 3, silver, with its smaller, tighter market, amplifies this move exponentially due to investment demand. 4, this price surge exposes the naked short positions in the paper market, forcing covering buys. 5, the soaring price and fear of shortage trigger panic buying from industrial users who must have the physical metal. 6, this physical panic manifests as soaring premiums and logistical chaos in key regions like Asia. 7, the premiums and chaos feed back into the investment thesis, attracting more capital, and the cycle intensifies. This is no longer a market. This is a run on the physical bank. And the troubling, undeniable fact is that for the first time in modern history, the tellers are looking into the vault and realizing there might not be enough to go around. The true measure of any financial system is not its performance during times of calm, but its resilience under the direct, unblinking pressure of a demand shock. We are now witnessing that test administered in real time to the global precious metals market. The $15 premium is the market's fever, but the inventory data is the scan revealing the infection's spread. Let's talk about deliverable supply. The London Bullion Market Association, LBMA, and the COMEX in New York are the twin pillars of the paper price discovery system. Their vaults, scattered in secure locations, are supposed to hold the physical backing for the billions of dollars in futures contracts and unallocated claims traded every day. For years, the system operated on a fractional reserve basis, much like modern banking. The assumption was that only a tiny percentage of claimants would ever ask for physical delivery at any one time. It was a comfortable, profitable fiction. That fiction is now colliding with a request for a reality check. Registered inventories in COMEX silver vaults, the metal specifically designated and available to settle the expiring futures contracts, have been in a persistent, grinding decline for years, punctuated by sharp, alarming drawdowns. Each rally has been met not with an increase in available metal, but with a drain. The recent vertical price move has accelerated this drain to a point of criticality. The ratio of open interest, paper contracts outstanding, to registered inventory has ballooned to historic, unsustainable levels. In simple terms, there are now far more paper claims on silver than there are readily deliverable bars to satisfy them. This is the mathematical expression of the disconnect. In London, the situation is more opaque but no less tense. The LBMA operates on a system of unallocated accounts, essentially pooled ownership, where you own a claim on a pool of metal, not a specific bar. The ease and liquidity of this system made it the default for institutional trading. But its weakness is now exposed. When trust erodes, every unallocated holder has the right to convert their claim into allocated specific bars. This process, called allocating, or taking delivery, removes that metal from the fungible pool and places it in your name, in a specific vault. It is the ultimate vote of no confidence. The whispers from the London market suggest this process is happening at an accelerating pace. The smart money isn't just buying, it is taking possession. This silent, continuous bleed of physical metal from the liquidity pool is what turns a price spike into a systemic event. This brings us to the most consequential yet least understood players in this drama, the central banks. For over a decade, their public narrative on gold has shifted from one of disinterest to one of strategic accumulation. Eastern central banks, led by China, Russia, India, and Turkey, have been consistent, relentless buyers, repatriating their gold from Bank of England and Federal Reserve vaults at a staggering clip. This was not investment, it was strategic de-dollarization. They were converting paper dollar reserves into sovereign, non-political, non-defaultable asset wealth. Their buying provided a steady, powerful bid under the gold market for years, a fact often underreported in Western financial media. Now, with gold breaking decisively above $500 to $400, their strategy is being vindicated in the most public way possible. but their role is now evolving from accumulator to potential catalyst. What happens if, sensing a permanent shift in the monetary order or a specific geopolitical trigger, a major central bank announces a significant one-time addition to its reserves? Or, more drastically, what if it begins to openly question the sufficiency of the gold backing behind major currencies or the London gold market itself? Such an action would be the equivalent of a central bank launching a short squeeze on the entire global system. The psychological impact would dwarf the financial one. It would be a signal that the era of trusting the Western-led paper gold system is officially, irrevocably over. The reaction of Western central banks, particularly the Federal Reserve and the European Central Bank, will be telling. Will they attempt to calm markets through verbal intervention or even undisclosed selling? Or will they, recognizing the same tectonic shifts, become reluctant buyers themselves, entering the fray and competing for the same shrinking pool of physical metal? Their silence in the face of this move is already a form of communication. It suggests there's no playbook for this, no Plaza Accord for gold. They are navigating uncharted and increasingly turbulent waters. Meanwhile, on Main Street, a different kind of awakening is occurring. The viral images of empty dealer shelves, of out-of-stock notices on popular silver bullion products, and of week-long delays on orders are doing what years of financial commentary could not. They are making the abstract tangible. The retail investor, often dismissed as the dumb money, is experiencing the physical shortage firsthand. They are not looking at charts of the gold-silver ratio or dollar index futures. They are looking at a sold-out web page and a $15 premium on an American Silver Eagle. This experience creates a psychological imprint far deeper than any market correction. It teaches the lesson that availability is not a guarantee. When the public learns that money cannot buy what it wants, when it wants, the very concept of liquidity is shattered. This grassroots physical buying, while small in volume compared to the institutional flows, is a critical component of the feedback loop. It removes the last, most visible layer of inventory from the system, creating a sense of public frenzy that feeds back into the institutional panic. We are left, then, with a system under strain from both ends. From the top, central banks and megafunds are seeking the ultimate safe haven asset, pulling large bars from the core of the system. From the bottom, retail investors and industrial users are stripping the easily accessible products from the periphery. The middle, the paper trading infrastructure of banks, brokers, and exchanges, is being hollowed out. Its legitimacy rests on the promise of convertibility. That promise is now being priced, and the price, as Shanghai tells us, is $15 and rising. The siren blaring from the Shanghai premium, the silent flight of gold bars across time zones, and the vertigo-inducing climb on the charts, all of it converges on a single, inescapable conclusion. This is not a supercycle. It is not a commodity boom. It is a monetary reset unfolding in real time. We have crossed the threshold where price discovery is no longer a function of leveraged bets on a screen, but of frantic bidding for the last truckload of real metal leaving a refinery. The paper market, with its infinite digital promises, has been exposed as a derivative of the physical world, not the other way around. And the physical world is shouting that it is exhausted. The decades-long deficit between mine supply and total demand, papered over by recycled scrap, and the drawdown of above-ground stockpiles, has finally hit zero. The buffer is gone. We are now in a state of permanent structural shortfall, where every ounce consumed by industry is an ounce permanently removed from monetary stockpiles unless replaced by new mining, and the mines cannot dig fast enough. This final stage of the crisis is characterized by the collapse of arbitrage. In a healthy global market, a $15 premium between London and Shanghai would be instantly erased by arbitrageurs. They would buy metal in London, ship it, and sell it in Shanghai, pocketing the difference and bringing the prices back into alignment. The fact that this premium persists and grows is proof that the arbitrage mechanism is broken. The reason is simple. The arbitrageurs cannot find enough guaranteed deliverable metal in London to make the trade. The logistical and financial risk of trying has outstripped the reward. The world's two largest precious metals markets are decoupling. When London and Shanghai divorce, there is no global price left, only local desperation. In this environment, traditional analysis becomes not just useless, but dangerous. Talking about resistance levels or overbought stochastic oscillators in the face of a fundamental supply collapse is like using a thermometer to put out a house fire. The old models assumed liquidity. The new reality is illiquidity. The price is no longer set by the marginal speculative seller. It is set by the most desperate industrial buyer who cannot afford to shut down a factory, or the sovereign fund that must meet a quarterly allocation target at any cost. So, what comes next? The path forward fractures into starkly different possibilities, each with profound implications. Scenario 1, the managed breakdown. The monetary authorities and major banks, in a coordinated last stand, attempt to regain control. This could involve the unprecedented use of central bank gold reserves to lend into the market, suppressing the price and allowing shorts to cover. It could involve the imposition of trading halts, position limits, or even the temporary closure of the physical withdrawal mechanism from major vaults, citing extraordinary market conditions. They would attempt to force the paper and physical markets back into alignment through administrative fiat. The short-term effect might be a violent, engineered price crash, a smash of historic proportions. But the long-term signal would be catastrophic. It would be a formal admission that the free market for precious metals no longer exists, and that the system's guardians view physical metal as a threat to be contained. The loss of trust would be permanent. The next rally would be even more violent, and it would begin from a much higher floor of distrust. Scenario 2, the disorderly reset. Coordination fails or is not attempted. The price continues its ascent until it finds a new, unimaginable clearing level, a level where enough physical metal is coaxed out of strong hands, through profit-taking or forced liquidation elsewhere, to momentarily satisfy the desperate demand. This is the parabolic spike of market lore. In this scenario, silver could see triple-digit percentage moves in days, not weeks. Gold's climb would revalue all global assets in its wake. The resulting financial chaos would be immense. Mining stocks would become the most valuable equities on Earth. Counterparty failures would ripple through the banking sector as derivatives tied to metals prices exploded. The US dollar's decline would accelerate into a rout, triggering a global inflationary tsunami as all dollar-priced commodities repriced higher. A new monetary paradigm, born not from negotiation but from market force, would emerge. Gold and silver would be de facto, if not de jure, recognized as the ultimate Tier 1 assets, backing a new fractured system of regional currencies or digital equivalents. Scenario 3, the political reckoning. The crisis moves from trading desks to parliamentary floors. Hearings are called. Speculators and hoarders are blamed. Proposals for windfall taxes on metal profits, or even calls for the nationalization of strategic metal stockpiles, de facto or de jure, gain traction. The narrative shifts from one of monetary failure to one of resource scarcity and fairness. This path politicizes the ownership of physical wealth and could lead to capital controls or confiscatory measures, echoing the Executive Order 6102 of 1933, but in a digital, far more enforceable age. It represents the final death knell for the idea of private, non-state money. Regardless of the path, the outcome is the same. The world that existed on January 27, 2026 is gone. The $15 premium was its obituary. For the individual, the implications are clear and actionable. This is no longer about portfolio diversification. It is about strategic financial defense. The insurance policy is being called upon. The questions are no longer, what is the target price? Or when should I take profits? The questions are now, is my metal truly mine? Is it allocated, segregated, and held in a jurisdictionally safe vault? Or is it another unallocated promise? Is it accessible? In a world of capital controls, travel restrictions, or banking stress, can you physically claim your wealth? What is its purpose? Is it to be traded for a depreciating currency later, or is it to preserve generational wealth through the transition to whatever comes next? The events of this day, January 28, 2026, marked the moment the ticking of the monetary clock grew too loud to ignore. The disconnect between paper and physical has moved from an academic concern to a market-moving fact. The velocity of capital abandoning symbolic value for tangible value has reached escape velocity. The rally is over. What you are watching now is the great repricing. It is the sound of a century of financial engineering unwinding, of promises being tested and found wanting, of the immutable laws of scarcity reasserting themselves over the seductive fiction of infinite liquidity. The charts will continue to update, the pundits will continue to debate, but the foundational shift has already occurred. The ghost left the vault, and it isn't coming back.